What is up, YouTube? What's up, guys? Welcome back to another post-trading analysis video. And man, oh man, it has been a juicy day. We netted over 10% in a single trading day, guys. That's absolutely nuts. Took two trades on gold and on Bitcoin, and Wyckoff absolutely nailed it yet again. Okay, guys, I'm telling you, I'm not pushing this Wyckoff narrative for a bullshit reason. Okay, I'm not selling you anything. I'm not promoting nonsense. You're watching me trade it live every single day for 4 months now. Okay, you may know me for a month alone, but I've been doing this public for 4 months. Okay, so you can go back and watch the old videos, but it works. Okay, it absolutely works. So we're going to talk about the two trades that I took on Bitcoin and gold. Then we're going to go over some more macro Bitcoin price action because in my opinion, things are potentially starting to look nice for more upwards or upside. Yeah. And lastly, we're going to talk about risk management. Got this question today from, I think his name was Darrett. If I'm saying your name wrong, excuse me. But he was asking me questions about leverage. And I was talking with another person about, the margin I'm using for my position sizes. And I think a lot of people have a misunderstanding of how leverage works and why we use it as professional traders. So I think that's a very important topic to also go into once in a while. So, it's not a problem that you do not understand it, because once you're beginning, it's hard to grasp and hard to make a concept around it, because you're like, what is this leverage thing? Because every non-trader will tell you, oh, leverage is gambling, leverage is this, don't touch leverage. Guys, leverage is a tool to leverage your margin while still risking 1% of your account balance, but you can just make more. It's not a gambling tool. It's an efficient tool that traders basically need, right, in order to gain momentum on your account balance. So I'm going to go all into it in detail in today's video. First, let's get into the trades, okay? So we're going to talk about some more macro Bitcoin price action after talking about the trades. So for now, what you just need to know is that Bitcoin deviated that macro range low. As you can see right here on the dot, that's the deviation. And then from there, we have an uptrend, okay? I'm pretty convinced that this is the low on Bitcoin. But from there, we have higher lows and higher highs. Let's make that black. Now, it's very important that we do not lose this structure. However, this 4-hour low is backed by, I think it was an 8-hour order block. There you go. Nice little 8-hour order block. And as long as we do not lose that low, there's nothing to worry about. Obviously, to get a retracement into that order block for a potential higher low, what you need is some sort of downward structure. So following structure from the top down, obviously you have lower highs and lower lows. Okay, lower highs and lower lows. There you go. And that's why you can pull your range on a more macro time frame from two perspectives. You could pull it from top to bottom, following your black market structure drawing, because that's pointing up. Or you can follow your red market structure drawing and pull it from bottom to top. Now, this is where you just need to look at what price is giving you, okay? What is price giving you? Now, if I get rid of the EQ so you can see it more clearly, what looks more clean? This bigger range, right? This range, or this range? What looks more clean? Well, obviously, if you just look at where price action has spent the most time, it's obviously inside this more local range right here. You can see that this local range is getting respected like crazy, bouncing, spending time around the middle of the range. So now what I would do is I would use the red market structure drawing range. Unless we start coming up and we start deviating the high, coming back inside, spending some time here, that's when I'll apply the bigger black market structure drawing range, okay? And that's also, let's say you get an accumulation here, a 1, 2, and a 3, and that hit its target. I'm sorry, guys. I'm having a bit of throat problem, so doing my best for you. But that's also why if I'm trading the red market structure drawing range and that hits its target, I can ignore that once it hit its target and start trading the black one if we deviate that high, right? So it's not that you need to have a fixed one. For now, we can trade the red one because it just looks the most clean, right? Because it has spent the most time inside of the red market structure drawing ranges. And then until we start deviating more, we can start using the bigger one. But for now, the red market structure range looks the cleanest, okay? So I'm gonna get rid of the bigger range, get rid of this market structure drawing tool, and check what price action is giving us. So looking at this range following your red market structure drawing, what you can see is you have your range low and you have your range high, and then from there you have deviation 1 tapping into that demand zone, okay? That was basically it. Now, getting rid of this EQ because it will make it more clearly later on. There you go. Now, obviously I'm checking, okay, we have this range. Where is my demand? Where is my supply? Okay. Now, looking for demand in this range, basically following this upward structure, almost everything has kind of been mitigated, okay? Except for the pullback and the bounce we got from that 8-hour demand zone, because right here we can see this 30-minute black candle, which is basically a 30-minute order block, okay? It's a nice pullback candle that caused the expansion away, indicating that buyers definitely stepped in here because they pushed price higher. And you can see that after the candle creation, a nice little tiny inefficiency was created, making it a nice order block, okay? Now, so I'm seeing, okay, we have some order blocks below us right here on the 30-minute time frame. Where is supply, okay? Where is supply? Now, if we look at the top of the range, we can clearly see that this had its own little range right here, where this was your range high, this was your range low. Price took it and then boom, dumped down, okay? Indicating that definitely in this whole move up, sellers were filling their positions, pushing price eventually lower. And then especially in this last upwards candle on the second dot, that's where they really entered and pushed price down aggressively. But in general, this entire range is supply because the purpose of the range was to push price lower. Okay? So this whole range is range supply. And then within the range supply, you have more refined zones. Okay? So if I go on the 2-hour, you can see this order block, which indicates that last push up before dumping down. But in general, this whole range is range supply, okay? Because sellers stepped in and broke the range towards the downside. Now, knowing that, that was kind of my plan going into the weekend, okay? I've told you guys many times, okay, that Sundays are good to trade. Saturdays suck, but Sundays are decent trading days. Now, what's the most important structure that we need to look for in this range going into the weekend? Well, obviously, after we had the deviation, we're just following the structure from the low up, right? Higher lows and higher highs. There you go. Right here is where the weekend opened. Boom. Saturday, boom. Weekend opened. The most important structure after deviating the range low is obviously structure from the low up, because if you break that back to bearish, that's when you can start seeing some lower prices, okay? Potentially coming back down, tapping into this demand zone before moving higher. Now, what do we do, guys, when we have a local uptrend? We pull our range from top to bottom, all explained in the Wyckoff tutorial, okay? We pull our range from top to bottom. So, going into the weekend, as we can see, Saturday, nothing happened. Saturday, right until Sunday open, price was just literally ranging inside of the range that we have laid out, okay? Nothing special happened until Sunday morning, okay? So we have our range high, we have our range low, and then we have deviation numero uno. So we extended, boom. Perfectly, there you go. As we can see, on Saturday, price was just slowly grinding up, coming into that deviation, tapping supply to perfection, guys. This is a perfect supply tap, okay? Absolutely perfect supply tap. So price grinded up, leaving a beautiful trail of liquidity behind. Okay, absolute beauty of a trail of liquidity. Lots of sell side liquidity below us. All the weekend traders opening long positions, their stop losses are all below this liquidity trail, making for a nice return to zone. Okay. Then what happens from there is we already know, okay, we have deviation 1. So we should be looking for either a potential model 1 distribution or a model 2 distribution, where the model 2 would just be a third tab that is a lower high, and then your model 1 would obviously be another sweep of the range high. So I'm checking price action, okay? And I was not behind the charts the entire time. And I saw a few people that took the Model 2 distribution short. Oh, my throat is killing me, guys. Give me 1 sec. So I saw a few people that laid out this supply zone right here. Laid out the supply zone. Boom. There you go. And then saw the break of structure coming into that high right here. You had that SFP first. And after the SFP, you got the actual break. Okay? There you go, break of structure. So right here, I saw people posting about this Model 2 distribution. You had to return to zone. You tapped into supply. And guess what, guys? You didn't only tap into supply. You tapped into supply in the premium pricing of the bigger range, because it's above the EQ of the bigger range. So you're in supply in the premium pricing of the bigger range, while also, if you pull your volume profile at that moment in time, your volume profile's volume area high is deviated, aka you are at the upper section of your bigger range. So it's the most ideal place, because I always say context is key. It's an ideal place to put in some sort of a distribution for a local retracement, okay? Because we're in premium pricing of the bigger range, we tapped into supply in premium pricing while deviating the volume area high of the range, aka you're in the upper echelon of ranges based on supply, range discount, and premium pricings and volume profiles. So it's the ideal place to look for some sort of a distribution. It makes sense, okay? Especially after deviating the low and grinding upwards ever since. It makes sense to have some sort of pullback. And I was hoping for a pullback all the way down to 57K, but we'll get into that later, okay? I'm just saying context is key, and I'm always using context to determine whether it's a high probability Wyckoff or not, okay? And this was because we got a Wyckoff in an area on the chart that is key, while it being a mid-time frame Wyckoff, and it has an amazing return to zone. So now we just need to wait for our confirmations. Now, I saw people take this Model 2 distribution short, and I'm not mad at all. This is totally valid, okay? The supply zone isn't the cleanest, okay? The supply zone isn't the cleanest, but it's still valid to take it on this break. And as I said in the Wyckoff tutorial part 2, is that if you take a trade, or not even if you take a trade, my taken trades that are losses, almost 70% of the trades that I take that are losses end up being winners. Is just a model flowing into another model. What I mean with that, if I take a loss, let's say I took this Model 2 distribution short, and it was a loss because obviously we wicked the stop loss, it is because it turned into a Model 1. Okay, it is because it turned into a Model 1. And in those scenarios, guys, you just have to take one L to get the W. Because this win was a 7% gain on the account. And the loss would have been a 1% loss. So you would lose 1% to gain 7, okay? Now, I didn't take this trade purely because I wasn't behind the PC and I wasn't aware of this setup, okay? I had an alert at the high. Because one thing I can tell you to potentially take into consideration not taking this trade is that there was a time in Bitcoin's price behavior where perfect taps always got taken out. I'm talking always, guys. There was a point in time where every perfect tap, because mind you, this is a perfect tap, got taken out. And my idea and my ideology behind it is that people set limit orders on these blocks and it's just too easy. So what they do is they set a limit order, price pushes down, they put their stop loss to entry, and the market makers realize that, see that, and they let price come up, take out the perfect mitigation before actually moving price in towards the desired direction. So that was a very familiar concept back in the days when volatility was coming back, and volatility is coming back. So it is something to be aware of. It's a little golden nugget I'm telling you guys here, okay? So note this down. When you have, and I'm talking a perfect tap, like I can zoom in for you guys. This is like a perfect tap because this is even perfectly drawn right here. Boom. Like that's a perfect tap. Okay, this you have to compare these taps, okay? This is a perfect tap. This is a good mitigation, okay? So take it into consideration because that happened quite a lot back in the days where all these perfect taps got taken out after an aggressive move, okay? Now, I saw this, I had an alert, right? And my alert went off. And I was paying close attention into price coming into that high. Obviously, the whole ideology behind the Model 1 is that we take out the stop losses from the second tap and then we move down. That's the whole idea behind the Model 1, right? The whole idea behind the Model 1. Now, I'm watching price action, okay? I'm on the 1 minute. I'm watching price action come towards that third tap high, and look what happened, okay? I'm watching price action very closely, okay? We're trending up on the 1 minute. We take that high, boom. Immediately after taking the high, price got smacked down. It is like price was forced, they forced price to come up to take those stop losses, and then the moment those stop losses got taken on the 1 minute, we immediately got smacked down after the deeper mitigation, smacking down $365. Okay, so this 1 minute break already confirmed my entire idea about price coming up one more time to take all these stop loss on the left, because obviously they took it and they dumped price down, breaking local structure. That is why this 1 minute break was already enough for me to go short. It was already enough for me to go short because my idea was I want that high to be taken and I want an aggressive move down, breaking structure. And this whole move on the 1 minute confirmed that entire idea of the Model 1 playing out. So on that 1 minute break was my entry. And then we target obviously the range low and even lower, okay? Because I was still holding that trade all the way down to here. And I'm currently still in that trade with a tiny position, okay? But we have a Model 1 distribution coming into a key area on the chart, volume area high, premium pricing supply, and we're coming into it. And then guess what? This was on Sunday midday, okay? Sunday midday, we got that third deviation, breaking structure, and then guess when the move down happened aggressively. Let me see. Boom. Check this. And this is what I try to tell people also on Twitter of like, okay, so Monday opens and price immediately dumps $1,260, 2% towards the downside, just immediately, okay? Ask yourself, be a rational person and ask yourself, do you really think that Mr. Market Maker exactly on 12 p.m., midnight, Monday open, goes behind his PC and then decides to press a few buttons? Or do you think they position themselves before the market opens, technically speaking on the traditional markets, but in crypto, it's always open. But do you think they push price down and enter, this is very important, enter exactly on Monday open? Or do they position themselves correctly before Monday open and then push it down further. Obviously, it's the second option, guys. Right here, they were already fully positioned to dump price on Monday open. And that's why Sunday is also such a key trading day, okay? Sunday is a key trading day because you'll always get these Wyckoffs that are getting completed on Monday open. I literally said in the Discord, I would like a retest prior to Monday open around Sunday closing, and then on Monday open dump down. And it's exactly what happened. Like, it happens all the time, and once you see it, you're just like, yet again, another manipulation event. So yeah, we had the model 1 distribution. We had to return to zone. And obviously, when you're entering on a 1 minute break, you have to pay attention to what happens on the higher time frame breaks. So right here, we had that 10-minute low, okay? And what happened is that we started SFPing that 10-minute low, okay? Whenever that happens, I'm paying a lot of importance, and I'm putting a lot of importance on the structure from the top down. Because if you start deviating the low, you do not want to break your structure from the top down back to bullish, okay? You do not want that to happen. Because if you are failing to break your structure on the higher time frame from the low up, and you break your structure from the top down back to bullish, you know, that's when price can just easily have a rotation back up towards the high and the distribution will fill, okay? However, we just never broke that high. It's very simple. We never broke that high, and SFPs, they can be temporary, okay? So this SFP didn't do anything because it couldn't break structure from top to bottom. And then right here, we had a tiny distribution, and price dumped down even more. Oh, my throat is killing me. Okay. So the trade we took was an exact entry all the way up here. It was around 59,950. There you go. And then stop loss above the high, and then we targeted the low. And the reason, okay, the reason I target the low, but the reason I was also targeting down towards this 57K area is because this would be the place which would be ideal to put in that third tap for the bigger accumulation schematic, okay? That's the reason why I had my last TP around 57. But it's looking like it already wants to reverse in some way, okay? So we're going to talk about that later. But yeah, guys, just so you know, to recap it on Bitcoin, we had a mid time frame Wyckoff distribution because it's also on the, let's delete this. Let's delete all these dots like this. It's so messy. So messy. I don't like my charts messy, guys. Always keep your charts clean. Always. Okay. Yeah, so it's around a 1 hour, 45-minute Wyckoff. Very clean. Tabs are divided very equally. We got the confirmation. We got the aggressive sell on the third tap. And then we were just following a structure to break more and more bearish on the higher time frames. And we had to return to zone. We came into a key area on the chart, aka premium pricing, deviating the macro volume area high, tapping into extreme supply. Not extreme supply, premium pricing supply. Okay? So that is that. Now, what has happened since then is that it kind of looks like it's turning into PO3. And you may not be familiar with a PO3, but PO3 is where, you know, your distribution hits its target and then kind of goes over into a manipulation phase right here. And then you get the expansion away back up towards the high. And it would make sense. I would have just preferred it if this manipulation phase or just like this pullback could have tapped in that 57K area. But, you know, we'll see what happens. Stop loss is in massive profits. It was already a 6+% gain on the account on the Bitcoin trade alone. So it's absolutely lovely. Lovely Wyckoff. Lovely execution, and we'll go into Bitcoin a bit more in depth later on in the video, okay? Now, going into gold, because I actually had my second trade that was on gold, and man, oh man, it wasn't a Wyckoff trade. It wasn't a Wyckoff trade, but it was absolutely lovely, okay? Absolutely lovely. So gold, took its all-time high. That's pretty fucking nuts. It took its all-time high, kind of indicating that the distribution is failing as long as it doesn't turn into a PO3. But I was just watching my local structure to watch for any signs of local pullbacks before continuing higher, because that's kind of how price behaves when you're in all-time high territory. So right here, following your structure on just the low time frame, your higher lows and higher highs, making this your market structure low, and that's where you got that first break, okay? Indicating that some sort of retrace before a continuation higher is definitely possible, okay? So following our structure, you got that lower high and lower low, and that's kind of where you were at on the charts. Now, as I discussed in my previous video going over gold, I like to use my market sessions on commodities and Forex, okay? So applying our market sessions, we can clearly see that we have our Asia high, which is right around here, okay? We have our Asia high that's right around there. Let's call it Asia. And then we have our Asia low that's right around here. Okay? We can call it Asia. And for the people that don't know, this is an indicator that I use where the purple colored candles are the price action during the Asia session. The blue colored candles are the colored candles in price action during the London session. And the orange is representing New York. And then the pink is representing New York PM session. Okay? So price action following the 5-minute time frame is downtrending. Okay? We got that breakout structure. Then we had the lower high for the lower low. Now, from there, obviously, to get that retracement for a potential lower high, we have some sort of an uptrend. Your black market structure drawing. Using your black market structure drawing, you're in the local uptrend. In the local uptrend, you pull your range from top to bottom, and then you get this. And this is, again, guys, it's again a situation where, yes, you can pull your ranges from two perspectives, from top to bottom using your red market structure drawing, and from bottom to top using your red market structure drawing, and then from top to bottom using your black one. You just have to see what looks better, because what looks better in this moment is obviously this range, because all the price action is in that range, right? If you compare it to this range, there is no price action here, okay? So applying this local range makes more sense in that moment, okay? And it's all about moments. So that's why I'm using my black market structure drawing and not my red one, because this looks just way cleaner. And then what can we see is that the moment London opens, okay, the moment London opens right here, we get this move up, deviating our range high, our second tap, okay? Normally, when we trade Wyckoffs, we always trade the third tap, but I also have entry models based around a second tap, okay? They're a bit more, I would say, risky. Win rate is a bit lower, but applying it with your Asia sessions and your session liquidity points, it can be very effective, okay? Not as effective as Wyckoff, but profitable effective, okay? Wyckoff is just insane. But, what we had is on the London Open, we had that move up, not only deviating our range high, also taking out our Asia liquidity. So what you just need to wait for, and what I am waiting for, is a break back inside my range, right? So I'm following my structure from bottom to top on the 1 minute, and you have higher lows and higher highs. There you go. And then you break structure. So right here, we get that structure break back inside our original range values after sweeping our Asia session high liquidity, breaking back inside. Stop goes above the high. Not only that, we have beautiful trend line sell side liquidity below us within the range, right? That's one. Beautiful sell side liquidity below us within the range. And not only that, our Asia session low liquidity is also below the range. Guess what? Backed by zero support, because this is also just liquidity. So what price is doing is it's ranging, okay? It's ranging, and then London opens, and you deviate your range high, taking out your Asia liquidity. You're already in a local downtrend on the 5 minutes, so you would expect a lower high for a lower low either way. And now you're getting that lower high and a lower low in a range confirmation trade where you sweep Asia session high liquidity, break structure back inside the range, and you have beautiful sells of liquidity below us. You can take a take profit here for a 3% gain, and then you can run it down even further to your Asia session low for a 4.7% gain. And I just took partials, 50% here, 50% here, okay? Which will make it in the middle or on a 3.5% gain. So that's why we netted over 10% in a single day. A range deviation trade short that netted me over 3.5%, and a Bitcoin trade that netted me over 6%, right? So we're trading the second tap here. When you want to trade a Wyckoff, you would want this to come back to that supply zone and then dump down further, but it doesn't have to, okay? It doesn't have to come back for that supply because it already grabbed the liquidity. Market makers already filled their position here. Yes, it can come back. It can come back for supply and you get that third tap, but it doesn't have to. That's why you can already enter on that break. And when you apply this range deviation trades with your Asia session highs and your London session highs and your New York session highs, it becomes so much more effective because if you already, let's say it did end up becoming a Model 2 distribution, okay? Let's say you had your supply zone here and price came back for it. You wouldn't have worried at all because when you trade the second tap and you enter here, your stop goes here. So whether price comes back for that mitigation for the third tap, it doesn't matter. Your stop loss is safe. Now, it's very important that the stop loss is safe. And when you're trading range deviations with your liquidity points, it becomes way more safe than if you use them without. Because if you use them without, and there's actually a liquidity point above your second tap high, it could become a Model 1. It could become a Model 1 where it comes back up and it takes back high again, right? Because it had a reason to. But because you're trading a range deviation second tap, where the second tap took all that liquidity, it has no more reason to surpass that high once more. And that's where you can trade range deviation setups, aka second taps. Because whether it becomes a Model 2 or not, doesn't matter. In both scenarios, it will be a winning trade. But you can only trade it that way if you combine it with your Asia session highs and lows, because if we had liquidity above that second tab or supply above that second tab, it couldn't come back higher and stop you out. But even if it stops you out, you could also just re-enter. And that again would be a scenario where your L will turn into a W and you just have to accept the L, okay? But the point I'm trying to make here is when you trade your range deviations backed by Asia session or just not even Asia session, market session liquidity points, it becomes so much more effective because you tell me that this doesn't look just fucking clean, guys. This doesn't look clean. Like, don't you see how manipulated these markets are? Don't you see the algorithms that are working here? It's absolutely nuts because guess what happened, guys? Guess what happened? Right here you have a range, another range, okay? Guess what? This is your London low. You see that blue price action? That's your London low. Guess what happened the moment New York entered or opened? The moment New York opened, you took your London low. The same way London took Asia. So London took Asia and pushed price lower. New York took London and pushed price higher. Like, these markets are so manipulated, and using smart money concepts and Wyckoff and liquidity, the way I'm displaying it here, range theory, you name it, you can become so profitable. So it's a bit different than Wyckoff, but it's basically around the same idea of them filling their short positions on this liquidity sweep and then reversing price lower. Okay? So second tap trade, second tap range deviation trade backed by your Asia session highs and lows. Very effective strategy. Okay? So those were the trades on gold and the trade on Bitcoin. Very simple if you ask me, right? I kind of trade a second tab and then I traded a Model 1. That's it. And where the second tab was just backed by session liquidity points, which is very effective. But if you're a beginner, I would start focusing on just Wyckoff first. And once you fully master Wyckoff, you'll be able to catch those range deviations where you just trade the second tap. But that all come with time, okay, guys? I've been doing this so long. So it will come with time. First, if you haven't mastered Wyckoff yet, just focus on Wyckoff and the trade I displayed here on Bitcoin, okay? Now, talking about some higher time frame price action on Bitcoin, and that things might or could be looking bullish here, is that I sound like a broken record, right? I sound like a broken record. But let's delete this price action so it becomes more clear for you guys. But let's even delete these order blocks. I want to look clean. Okay. Talking about Bitcoin on the higher time frame, okay? We obviously know that we have been in a range and we have just been deviating the low over and over again. And you have to ask yourself, if this was actually the top, if this was actually the cycle's top, why would market makers not just dump price lower like every single bear market, but instead let price deviate 1 time, 2 time, 3 time, 4 times, again and again and again, coming back inside after every single deviation over and over again? Why would they just not dump price? Well, it's because their intention of this pullback is not to dump price into new bear market lows. It's to actually accumulate Bitcoin to break this range out towards the upside, okay? And the difference between this last deviation, okay, the difference between this last deviation compared to all other deviations is that this deviation actually did something. It mitigated well-needed demand, okay? You can see it right here on the left. It basically mitigated every single demand zone you could pull from this area, okay? And not only did this last deviation mitigate demand, it had also one of the biggest VIX spikes ever, okay? And with VIX spikes, I mean the volatility index. So the volatility was at its highest in this last deviation towards the downside, indicating that the sentiment was at an absolute worst. I remember you had the Japanese stock market collapsing, worldwide recession, you name it, countries in America selling Bitcoin, like you name it, it was all in there, creating massive panic attacks, creating high volatility. So the reason for me saying that I think this deviation is actually the low of this macro range is because it had one of the largest volatility index spikes. It had one of the worst sentiment, and it actually did something. It mitigated demand. Okay? So what I was expecting was then obviously a higher low for a higher high. Now, I was pulling my volume profile to check what the volume profile was doing, and I realized that on this move up right here, we got this rejection from the volume area low right here. And obviously that's an important level to reclaim. But once you get a rejection from it, you shouldn't become all bear because we just pumped from that low. We just pumped over 28%. We pumped over 28% from that low. So if we do not, or if we aren't able to break that volume area low in one go, that's okay. That's okay. You can have a slight retracement before trying it again, coming higher. It is just very important that when that happens, you do not break structure from the low up. And structure from the low up is a higher low and a higher high, okay? Where this is just your market structure low, and then that's it. You do not want to break that low for bullish price action. But guess what? This low is backed by a strong looking 8-hour demand zone, which is where we got the perfect bounce from. So as long as we do not lose this upward structure, there's nothing to worry about. And this can simply be another higher low for, guess what, a higher high coming back in to your range and into your volume profile. And the reason why I said that price might start looking bullish on the higher time frames is because when you look at this, it looks like a very clean Wyckoff Model 2 accumulation schematic. Okay, so right here, like we just discussed earlier in the video, you have the 1, you have the 2, and this is looking like an amazing 3. Wyckoff Model 2 accumulation schematic. Okay, so I'm thinking this could potentially be the accumulation schematic for the higher low that sends us way back inside the 65K area in that range. Okay, now zooming in, this Model 2 accumulation schematic, technically speaking, hasn't met its requirements yet because it didn't grab extreme demand, or didn't mitigate extreme demand, and it didn't grab extreme liquidity. Because like we just discussed earlier, your extreme demand would be this 30-minute demand zone. And to back it up, you have extreme liquidity, which would just be that first market structure low that was created, which would be right here. That is also why I was aiming for 57K as my accumulation target, okay? Or for my short target, because from there it could turn into an accumulation. The reason why this could also be an accumulation, one, guys, it could for sure already be an accumulation because you already got the deviation here that mitigated demand. It would just be an untradeable Wyckoff Model 2 accumulation, but it would still be an accumulation. We just couldn't technically trade it from a high time frame perspective, okay? But like I was saying earlier, if I'm just checking this range and I was checking this distribution, it's kind of looking like that this distribution is just turning into a range, and then that breakdown was just your manipulation phase below the range low. And then from there, we have the expansion towards the upside where it kind of turns into a PO3. This is just a possible scenario. It will be very juicy. It would show smart money concepts in full effect. But yeah, I wouldn't mind a deviation back inside that 57K area for a better Model 2 tab, but it wouldn't need to happen now. Otherwise, it would just be extended too much. But in general, even if it doesn't, it could still be an accumulation schematic. It would just be untradeable from a high time frame perspective. But if I go on like the 8 hour, don't you see how clean this looks? Don't you see how clean this looks? It looks so clean, guys. It's so clean. Now, we do have some levels that we need to be aware of and that we need to break. And the most important one being this 4-hour order block. Okay? Why is it so important? Well, if we come up higher and we tap that range high, we can use this range pool. Okay? Following that black market structure drawing from the low up discussed earlier in the video. Okay? So why this is so important is you do not want to see price start distributing coming into that important order block, okay? Because then you would be failing to break that volume area low on the macro range right here while tapping into supply, distributing, okay? That's the last thing that we want to see. So once we break above this 4-hour supply zone around 65K, if you come in that 65K area or just in general, you get a deep mitigation in that supply zone, kind of already indicating that it's failing, then I'll be chilling, okay? Then we'll be absolutely chilling and we'll start looking for swing longs to take towards the massive range high. And then obviously another important order block that we need to be aware of is this 12-hour order block, because this is actually a market maker order block, okay? Why is it a market maker order block? It's an order block backed by a Wyckoff schematic, and it was this massive Wyckoff schematic right here on the left where you had the 1, you had the 2, and you had the 3. That dumped us down over 30%, okay? How much was that actually? Yeah, around 30%. So this is a very key order block that we need to break. But I think once we do get there, price will maybe get like, let's say we come in here, we back test it, come back up. I think we can get a rejection from it, but if we get there, we'd have already surpassed and already got an acceptance back inside this massive range. I think from there, we just eventually make our way up towards that range high, okay? But it's starting to look pretty decent because like I discussed, you can look at this range from multiple angles, okay? Just like on the higher time frame, okay? Just like on the higher time frame where you can pull this range using weekly structure and you will have this, okay? Just like you can pull your range like that and use those deviations, you can also just watch your red market structure drawing that goes something like this, right? And using your red market structure drawing, you're in a local downtrend. We do this on every single time frame. On the high time frame, it's not different. And then using your red market structure drawing, you can use it from bottom to top. There you go. And then when you have that, you realize, hey, this could be a 1, a 2, a 3. Because guess what, guys? This 3 actually did its thing. This 3 tapped extreme demand. So this 3 is a valid Wyckoff Model 2 accumulation where your third tap can have its own 1, 2, 3. Making its way towards this range high. And then once you break this range high, obviously we're coming towards that bigger range high, right? It's the exact same way. The same way I've just discussed it on Bitcoin and the same way I've just discussed it on gold in my local trades. The same way we can use it on Bitcoin on the higher time frame. These concepts don't work differently if we use it on high time frame candles, right? So this can easily be a Model 2 accumulation where literally your third tap is having, as we speak, its own little Wyckoff Model 2 accumulation that's just untradeable on the 4-hour time frame, for example, right? Because we would have preferred this mitigation a bit deeper. But that's it, guys. That's it. It's still valid, okay? It's still an accumulation. We're just not going to trade it on a 4-hour time frame. But locally speaking, we can find a long and we can run it all the way back up towards 70K. And then from 70K, it will be a fast move towards 74, okay? So yes, I'm betting heavily on Bitcoin going higher. I'm buying altcoins. You guys don't even understand. So much money. Because when I'm trading in my full capacity, I'll make 10 to 20% a week, okay? 10 to 20% a week. That's 80% a month, okay? So if I'm trading full capacity, I'm making 80% a month max. Like that's insane. I've never made 80% in a single month. But if I'm trading full capacity and I have like a very, 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 very good month, I'll make 80%. Bro, in crypto, you can make 80% in a single hour. Literally. So if you're not betting on crypto while trading as well, you're doing something wrong and you're going to miss out on gains. Okay? So I've been ranting for 47 minutes. I want to talk about leverage. Okay? Let's talk about leverage and then we wrap it up for tonight. So talking about leverage, guys, we're just going to do simple math. Okay? For this scenario, to understand leverage, we're going to talk about an example where, okay, we have an account balance and that's $2,000. Okay? Account balance is $2,000. What we want is we want to risk 1% per trade. Or let's do 5%. 5% per trade. Okay? Equal to $100 is $100. This is very key. Our account balance, $2,000. We can say account balance. Okay. Every single trade, we want to risk 5% because we're starting out small, so our risk percentage of the account can be higher. So I want to risk $100 in a single trade. Per trade, I want to risk $100. Very nice number to use. Okay. Well, in the trade I just discussed on Bitcoin on the lower time frame, we can actually measure, right? This was our trade. And our entry was right about here. So what was our stop loss size? That's what I'm aiming at, okay? What was our stop loss size? Our stop loss size, we can see right here. Our stop loss size was 0.48%. Very important, okay? Our stop loss size is 0.48%. Now, if we go back to our live trader that has a 2,000 account balance, where is my text? There you go. So I have a trade, okay? My stop loss size of the trade is 0.48%. Now you need to calculate what is going to be my position size for this trade if I want to risk $100, okay? So let me get some water because my throat, guys. Okay. $100 is all that we want to lose. Okay, $100 is all that we want to lose. So $100 is equal to 100%. Okay? That's all that we want to lose. $100. So if we lose it, we lose 100%, we lose $100. $100 is 100%. Our stop loss size is 0.48%. In order to calculate what your position size is going to be, we have to divide $100, okay, by your position size or your stop loss size, okay, doing this correctly, and multiply it by 100. Let me double check this. I'm doing this every single time. No way I'm doing it wrong now, no? I'm gonna risk $100. Stop loss size, boom, times 100. Oh yeah. So if we calculate this, okay, that this will make for 20,833.33%. So again, we have a $2,000 account balance. I want to risk $100 every single trade. The stop loss size of this trade is 0.48%. So if my stop loss gets hit, I lose $100. In order for this 0.48% to be equal to $100, I need to have a position size that's 20,833. Okay? This needs to be my position size if I want to risk $100 with a stop loss size this tiny. In order to get this number, you can just divide your risk by the stop loss percentage, multiply it by 100. That's it. Okay? Just use this little math tool to calculate your position size. I don't think anyone calculates it like this, but it's the fastest way. It's the easiest way. Okay? Now, obviously, we only have $2,000 in our account. So we cannot, without leverage, short $20,833. So what you do then is you can go to leverage, okay, and you select 20x. 2,000 times 20 is 40,000. So now, right, now we have leverage to our capabilities. We want to fill a position that's 20,833. I only have $2,000 in the account. We can just go to leverage, select 20x, and trade up towards $40,000. And now we can fill our position size of 20,833 leverage or size, right? Now, if we want it to be exact, we can calculate, okay, I have 2,000. I need to fill 20,833, and I have 2,000. So we can actually do this. Okay, I have 20,833 that needs to be filled. I only have 2,000 divided by each other. I need 10.4x leverage. So if I go to leverage and I select 10.4x leverage, now I can trade with this needed size to risk $100 in the trade. Okay? Obviously, guys, there can be multiple trades throughout the day. So you don't want to use all your $2,000 in a single trade, because then you have no more margin no more leftover money to enter another trade without having to close the first one. So what we do to have some more money in the bank for other trades, we just go and we say, we select 20x. Okay. We select 20x leverage. That way, or you can even say 20.8 to make it more clear now. That way, okay, that way, you're only using half the account, okay? Because if we select 20.8x leverage, and I'm using half the account, our account is 2,000, so half the account is 1,000, and you divide it, or you multiply it by 20.8, which is your leverage now, you get that $20,800 position size. Now, unexperienced people will tell you, but with leverage, you can get liquidated. Guys, our stop loss size is 0.48%. That is so tiny, you're only risking $100 if that gets hit. Your liquidation price, let's say your stop loss price is at 60,000, okay? So when your stop loss gets hit, that's 0.48% away, equal to price hitting 60K. Your liquidation price may be fucking 64K away. Your liquidation price is nowhere near your stop loss level. If you get kicked out of the trade using leverage, right? If you get kicked out of the trade using leverage, you'll still only risk $100, which was your initial idea. What you could also do is you could up this leverage to a fucking 100x leverage, okay? You can select the leverage you want as long as the liquidation price is outside of your stop loss price. That's it. Because then your stop loss will get triggered before your liquidation price will get triggered. So you will never get liquidated, right? You'll just lose less margin. So you can open a $20,000 800 trade or $20,800 position size easily with 10.4x leverage. But with 10.4x leverage, you need to use your entire account balance. If you select 40 leverage, right, you need 4 times as less margin. That's it. You're still risking the same $100. If I put 10x leverage, I'm still risking $100. If I put 40 leverage, I'm still risking $100. If I put 100 leverage, I'm still risking $100. And my return will be the same. So people can make their percentage gain seem crazy on their MEXC screenshot by applying 99x leverage, but that doesn't mean shit because you're still risking $100. And it's risk to reward. So I'm risking $100 to make 300. Or in this case, I had a 6.7% gain, so I'm risking $100 to make $670. I'm just using leverage so I don't have to use all my margin in my account because I don't keep all my money on MEXC because the exchange is good, but I do not trust them with all my money. So I have a percentage of my account for trading on MEXC, and leverage allows me to fill all the position sizes. So when I'm talking about filling my position size, I'm talking about this 20,833 that needs to be filled. I only have 2,000 in my account. For me, it might be 20,000 and 200,000, right? But if I talk about I need to fill my position size, aka go from 20 or from 2 to 20, that's when I use my 10x leverage. So if you have any questions, guys, let me know. But leverage is just a tool we use so we don't have to use all our margin, or it's a tool we use to add to our margin so we can fill our position sizes. And there's nothing special and nothing crazy and cool if you use high leverage. No, it's all about risk to reward. And the risk stays the same despite your leverage when we're scalping and trading, if you do it correctly. Love all of you guys. Big things are coming. You wait. You're all going to make it. I love every single one of you. If you've watched till the end of the video, you're a goat. Love you and peace out.